Imagine turning a bold bet into a fortune, where a single trade can change your life forever. That's what happened to a select few who dared to venture beyond the ordinary. Today, we are diving deep into the realm of the extraordinary, exploring the top 5 trades that shattered records and expectations alike. These aren't just successful trades, they are legendary moves that redefined what's possible in the world of trading. Welcome aboard! I'm Dirk, your guide with 25 years of trading and investing experience. I've seen my share of remarkable trades, but the ones we're about to uncover, they're in a league of their own. If you are passionate about trading and eager to elevate your game, smash that like button, subscribe and get ready for weekly insights that could transform your approach. Stay tuned, especially for trade number 5. It's not just a record breaker, it's a piece of trading history, the most profitable trade ever made. Let's get started and cover these mind-blowing trading adventures together. Jesse Livermore, often referred as the Great Bear of Wall Street, was a self-made man who rose from a humble background to become one of the most successful stock traders of his era. He was known for his ability to read market patterns and his willingness to make bold, contrarian bets. Livermore had a unique talent for understanding market dynamics. By closely analyzing the stock market's behavior in the late 1920s, he became increasingly convinced that a massive downturn was imminent. His conviction was based on patterns he had observed in the market, including excessive speculation and leverage. Livermore began to short sell stocks, a strategy where he borrowed shares to sell them at the current high price with the expectation to buy them back later at a lower price. He targeted overvalued stocks that he believed would fall the most when the market crashed. When the stock market crashed in October 1929, Livermore's prediction proved correct. The prices of stocks he had shorted plummeted, allowing him to buy them back at a fraction of the price. This trade earned him a fortune, with estimates of his profit ranging around $100 million, equivalent to over $1 billion today. George Soros' trade against the British pound in 1992 is one of the most famous in financial history. This event, often referred to as the Black Wednesday, is a prime example of how a single investor can have a profound impact on a nation's economy. George Soros is a renowned investor and hedge fund manager, known for his deep understanding of financial markets and macroeconomic trends. He founded Soros Fund Management in 1970, which became one of the most successful hedge funds in history. In the early 1990s, the United Kingdom was part of the European Exchange Rate Mechanism, or short ERM, a system designed to reduce exchange rate variability and achieve monetary stability in preparation for the European Union and the introduction of the euro. However, the UK's high inflation rate and interest rates contrasted sharply with Germany's post-reunification policies, leading to a misalignment within the ERM. Soros, seeing an opportunity, speculated that the British pound was overvalued and could not maintain its ERM peg to the Deutsche Mark. He believed that the UK would have to either devalue the pound or leave the ERM. Soros' Quantum Fund began a massive short sell of the pound, borrowing and selling pounds in anticipation of buying them back later at a lower value after the currency's fall. This position was reportedly worth over $10 billion. On September 16, 1992, known as the Black Wednesday, the UK government faced immense pressure as billions of pounds were sold by speculators. Eventually, the UK government announced that the pound would be withdrawn from the ERM and allowed to float freely. This led to a significant devaluation of the pound. Soros' fund is estimated to have made over $1 billion in profit from this trade. His successful bet against the British pound earned him the nickname "the man who broke the Bank of England." Andrew Hall is a British-born trader known for his expertise in the oil markets. He gained prominence for his successful trading strategies, particularly in oil futures, and his ability to predict market trends. At the time of the trade, Hall was the head of Fibro, a commodities trading firm. Fibro, short for Phillips Brothers, was then a part of Citigroup, one of the largest financial services corporations in the world. In 2009, amidst the global financial crisis, Andrew Hall took a bullish stance on oil prices. He believed that the market was undervaluing oil and that prices would rebound despite the economic downturn and a significant drop in oil prices in 2008. Hall's strategy involved taking long positions in oil futures, essentially betting that the oil prices would increase. This position was contrary to the prevailing market sentiment at the time, as many investors were bearish due to the financial crisis. Hall's prediction proved to be correct. In 2009, oil prices rebounded sharply from their lows in 2008. This rebound in oil prices led to significant profits for Fibro and consequently for Hall. Reportedly, Hall's personal compensation for that year was around $100 million, primarily due to the profits generated from this oil trade. This high compensation became a subject of public attention and controversy, especially since Citigroup had received a substantial bailout from the US government during the financial crisis. The Black Scholes option trade refers not to a specific trading event, but to the development and application of the Black Scholes-Merton model, a revolutionary approach to pricing options. This model, developed by economists Fisher Black, Myron Scholes and Robert Merton, had a profound impact on financial markets. Unfortunately, Fisher Black passed away in 1995 and was not eligible for the Nobel Prize, which was awarded in 1997 to Scholes and Merton for their work. The model quickly became a fundamental tool in the financial industry, used by traders and investors to price and trade options more effectively and manage risk. The model is still used today by options traders like myself to calculate fair prices of options. Although not a trade in itself that made one trader millions or billions in profit, the availability of a reliable pricing model helped to fuel the growth of option markets, as it provided a common language and framework for traders across the globe. John Paulson is an American hedge fund manager who founded Paulson & Co. in 1994. Prior to the subprime mortgage crisis, he was a relatively unknown figure in the world of high finance. In 2005 and 2006, Paulson carefully analyzed the US housing market and concluded that the subprime mortgage sector was vastly overvalued and unsustainable. He noticed that many mortgages were being given to borrowers who were unlikely to repay, and these mortgages were then being repackaged into mortgage-backed securities, MBS, and sold to investors. Paulson decided to bet against the subprime mortgage market. To do this, he used financial instruments called credit default swaps, CDS. A CDS is essentially an assurance policy against the default of a debt instrument. By buying CDS, Paulson was betting that the mortgage-backed securities would fail. Paulson's fund started buying up the CDS contracts in large quantities. This was a highly risky strategy, as he was paying substantial premiums for these swaps, and if the housing markets remained stable, his fund would lose a significant amount of money. Paulson's predictions came true when the housing market began to collapse in 2007, leading to the broader financial crisis of 2008. The mortgage-backed securities plummeted in value as foreclosures rose and the true extent of bad debts became apparent. The collapse of these securities meant that the CDS contracts Paulson had purchased became hugely profitable. His fund is reported to have made profits of around $15 billion, with Paulson personally earning around $4 billion. That's it. 4 trades and 1 new strategy that shaped the financial markets like few others. What do you think was the greatest trade of all time? Leave me a comment underneath the video. Also make sure to like and subscribe to the channel and watch more videos like this to become a more professional trader yourself. Until we see each other again next time, happy investing.